All right, welcome everyone, and thanks David for having me at another great event. Thanks to Anka for another good presentation. For those that are just tuning in, the presentation is being recorded, so you can catch this one as well as Anka's and all the presentations afterwards as well to review them. Today, I'm going to be highlighting how to draw and use Fib retracements for day trading, specifically be pulling examples from the E-mini S&P. So I did want to touch on a few of the basics, even though, if you've watched their presentations today or throughout the series here the last couple of days, our focus is all on drawing fibs. So I'll just run through briefly how I draw them, how I use them, and then we'll get into more of the nitty gritty meat and potatoes of how I find setups, where I'm entering, placing trades, and how I kind of manage my trades. And I'll pull some examples from the E-mini S&P because that's what I mostly trade. But you could also be trading any other, intraday markets as well as even swing trading. The same methods work just fine for swing trading as they do day trading. Now, I will say when I swing trade or hold positions overnight, I typically do that. I don't do that in the futures markets. Usually I'm doing that through like, the SPY or the Qs, some sort of ETF or an individual stock, just to curb a little bit of risk. So same methods apply whether you're a swing trader or a day trader, but we'll spend a little more time and emphasis today talking about the E-mini S&P. So to give you a little bit of an outline of what we're going to run through, we're going to go through a little bit of kind of the basics of market structure and then the importance, as Anka was talking about kind of at the end of her presentation there, of the swing highs and swing lows, and how kind of piggybacking off of that, you can use those highs and lows in conjunction with the Fib retracements to really help determine, okay, should I be going long? Is this a reversal that I want to be getting in on the new direction? Or is this a pullback that I should be kind of ignoring the short-term pullback and be getting in on the sort of past longer-term trend? So we'll get into some of that. We'll talk about drawing fibs, the traditional retracements, and then what's called extensions, as well as then kind of the meat and potatoes of execution, and then some things that you can do to manage trades. I find that it's easy to get into a trade and then get stopped out, but it's very important to know what you're going to do if the trade goes your way ahead of time. Otherwise, you can kind of fall in the trap of just getting out way too early, and maybe you only have 2 or 3 big like home run trades or big winners for the week. And if you pull the plug too early, you might be stuck waiting another 4 or 5 days for a really great trade to come along. So there's some things that I like to do to kind of help limit my risk and lock in at least a small gain on the trade early. And then that way, when I have the kind of the single, to use the common baseball analogy, you hit that single, you get on base, and then you have a little bit, you're a little bit looser and you can kind of relax, and it allows me to stay in those trades, those winning trades, longer, versus if I got in the trade and then, it starts to go my way. If I just kind of let it be open-ended with a full stop still at my disposal, I might feel a little more concerned and say, well, I'm up 5 points. I really don't want to risk it going all the way back and stopping me out. So I'm just going to get out here. So, but I get a little bit ahead of myself here. So we'll jump into trade execution and management as kind of the third tier today. So for those that are new or unfamiliar with myself, my name is Tim Racette, and I blog over at eminimind.com. I've been trading since about 2006, and like I said, I'm mostly my day trading is consistent of the E-mini futures, mostly the S&P. NASDAQ is also pretty good. I don't do much YM Dow futures trading anymore, but mostly the ES is my bread and butter intraday. I do like the swing trade stocks and ETFs. I find that it does make a nice pairing because there's times where volatility is really low and intraday, like especially in the summer months, intraday, there's not always the huge ranges when the volatility is really low. And so it makes it easier to hold a trade for a couple of weeks, a swing trade, because there's less volatility and you can catch some bigger trends over the course of 2 or 3 weeks, sometimes even a month or two. And then on the flip side, when volatility is really high, there's not as many swing trading opportunities. I don't want to be holding overnight as much because that same, ETF or stock might be swinging up and then swinging down so quickly within the week that it's hard to stay in overnight for multiple weeks. And so then day trades are much more prevalent and are kind of more of my trading. So if you kind of to think of it like if you're 60% day trades, 40% swing trades, when volatility is a little bit higher, as volatility decreases, then it might only be 40% day trades and 60% swing trades. And then when things get really wild, as we might see here in a couple of weeks coming out of this Fed meeting announcement on the 21st, a couple of weeks from now, if volatility really cranks up, then swing trading doesn't present as many opportunities, but then there's a lot of day trading opportunities. So it kind of allows me to be a little bit more patient because if I'm already in a trade at the open, that's a swing trade, then I don't feel as much pressure to have to take a day trade. And that kind of feeling or just mindset of, okay, I don't have to take a trade today, really allows me to be more intentional and diligent with the trades that I do take. Have had the pleasure of speaking a number of these online presentations here, as well as Traders Expos in person and CME and that sort of thing. So it's always nice to get together and see some familiar faces and be able to chat with other traders. As you all probably know, it gets a little bit quiet and sometimes boring when it's just you at your home office or whatnot. So being able to bounce ideas off other traders and people is really helpful. Kind of, especially in my early years of trading, I had a colleague who we were kind of going alongside each other with day trading. He had some connections down on the board of trade, and so we were able to go down there and get connected with some other traders that kind of acted as mentors. But just having him to be able to bounce ideas off of, especially because we were trading pretty much the same way. You could say, oh, hey, I took this trade today, and he'd say, oh, well, I didn't take it, and here's why, or vice versa. Or, yeah, I took that same trade. And just being able to throw some ideas around with someone who is at least somewhat familiar was a really big benefit. So those kind of expos and even these online presentations situations can be good places to connect with other traders and find some common ground. Outside of trading, I'm a big fan of mountain biking and getting outside and exploring, hiking. Spend a lot of time in the outdoors and kind of split my time. I used to live in the Chicago area. Now, last 7-8 years, home base is kind of in Scottsdale, Arizona, and then spending the summers up in Spearfish, South Dakota. And I am a ASU Sun Devil, so go Devils. Let's get into kind of the meat and potatoes here. We're going to start with some of the Fibonacci basics and get into the identification of the trend, and then work our way in just a little bit to trade entries and trade management. I will try and keep my eye on the chat box here. So if you do have questions, feel free to type them in, and I'll try to kind of answer those as we go. That way you're kind of not left hanging. If you have a question early on and then it doesn't get answered till the end, sometimes that's not the most helpful to you. So as far as this idea of Fibonacci, as far as the sequence itself goes, starting with 0 and 1, the sequence is just made up of the previous two numbers. So you add those up, you get the next number. So you start with 0 plus 1 is 1, 1 plus 1 is 2, 2 plus 1 is 3. So taking the current number and the one before it, boom, that's what gets you the Fibonacci sequence. So if you, and Leonardo Fibonacci was this Italian mathematician who kind of came up with this sequence, discovered, if you will. And the idea is that you have this golden ratio that if you divide one number in the series by the number that follows, you end up with that 0.168. So kind of, okay, the sequence is adding the two numbers next to each other. And that's what gives you the next number. But if you divide, kind of going backwards, 8 by 5, 13 and 21, 55 and 34, kind of go going forward, excuse me, but dividing the numbers 5 by 8, that's what gives you that 0.16, that golden ratio that you kind of see throughout nature as far as like leaves and patterns and seashells, and the sort of face makeup kind of has this ratio of 0.618, excuse me. And so the this kind of sequence discovered in nature is what is kind of tied to some of these emotions that we have as far as when a price retreats, when does it feel to us as humans that it's at a discount or on sale, or when does it feel like it's too far, it's just too far gone to be able to recover. And so that's kind of just the foundation of the Fibonacci ratios, if you will, or numbers that you might see when you just pull up a basic Fibonacci tool. And so some of the more common ones, 38.2, the 61.8, those are numbers that you'll see a little bit more, and I'll go through how I kind of set up my numbers, because you don't really have to look at all of the numbers. There's just a couple that I find helpful, and you can kind of use as reference points as you go through looking at the chart. So one of the things that I think gets overlooked a lot is that you can go around looking for entry points, but the context of that entry point is super critical. So like if you take just a basic candlestick pattern, take a hammer, for instance, a little bullish reversal bar. Let's say you're looking at a daily chart. Well, if that hammer is occurring in the context of a downtrend, it has a much different impact than if it is in the context of an uptrend. So if you get a hammer when the market has pulled back in an uptrend, that's a great buying opportunity above the high, because the market is already shown that it's in a series of higher highs and higher lows, a nice uptrend, and the pullback is just kind of signaling, okay, a resumption of that trend, of that uptrend. When you get a hammer in a downtrend, you can get a short-term bounce, but it's more than likely just going to be short-term because the bigger context is down. So I always like to start with identifying the trend and looking for those opportunities to place that low risk entry point, at which point you can then look for the setup. So we all know, basic uptrend is highs after highs, higher high, higher low, whatnot. A downtrend, lower low, lower high. And that's pretty easy to determine when you just look at a chart, whether it's a daily or a 5-minute or 15-minute or an hourly. You can pick out those highs and lows and determine what the trend is. But a lot of times when the trend is already super clear and really visible and everyone sees the trend as it is, it's often too late. You just think of, fads or, trends in all kinds of things in life, not just trading. If it's already, you think back to most recently, like last couple of years with housing, things are going up and it's like, oh, I got to buy because we're trending up and everyone else is buying a house and there's not that many of them. So I got to jump in too. And so when was it not so clear that housing was trending up? Well, if you think back to 2010, 2011, 2012, you're coming off of a downtrend and it's not as clear. Or is this just a little bounce or are we actually trending higher? So that point, when the trend begins, is really kind of the critical piece to be able to start looking for trades. Whether you're a trend trader or a range-bound trader, you kind of need to know, are we in an uptrend, downtrend, or sideways trend? And so just have this little chart here. If you print out your chart, whether, like I said, it could be an hourly, a daily, a 5-minute, doesn't matter. Just go through and mark the highs and lows on the chart. And just mark, okay, is this low higher or lower than the previous one? So if you have a lower low, then move to the right. Always start from left and go to the right. And then take the next high. Okay, is this high lower or higher than the previous one? And that gives you a lower high in this case. And continue all the way through the chart, lower low, lower high. Then you keep coming over. Okay, oh, this one's a little bit higher. So now we got higher high, higher low. And you can highlight, okay, here's an uptrend, here's a downtrend. But what's critical is this shift when you go from a series of lower highs and lower lows, down, 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 to that shift of higher highs and higher lows, up, 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 up. And so what ends up happening is you have this break of a swing high when you're going from a downtrend to an uptrend. You were making lower highs and lower lows, lower high, lower low. You break that swing high, and that's what starts the potential for a new uptrend. Once you get the pullback, that's where forming the higher low by kind of making the next leg up initiates or begins that new trend. So if you just took the same chart and flipped it upside down, it would just be the exact same thing, only the other direction. You'd be making higher highs and higher lows. You break a swing low, and then you can start that new downtrend or the potential for the new downtrend. And that's where at the beginning of the trend, your risk is going to be the lowest because you can have your stop very tight, but your reward is going to be the highest because you're getting in early to the trend versus seeing the trend so clearly on the chart, waiting. Okay, it's been since 2009, home prices have gone up. It's now 2021. Yeah, honey, I think we should finally jump in. Or, hey, the stock market is going up, up, up. Hey, we start 2022. Okay, we're gonna finally buy. We sold out in the bottom of 2008 and we were too scared to get in, and yeah, everything's going up, so it's time to buy. Pretty much the opposite of what you want to be doing. You want to be looking at entries and looking to get into investments, trades, that sort of thing, buying into a business at the early stages. If you think about like an angel investor or a venture capital firm, they are looking to invest in a company early on so that they can put up $1 million and have relatively low risk, because if the potential is to crank out 10 or $100 million in a couple of years, they're early adopters, if you will. So that's where identifying where the trend is beginning, or you could look at another way and say, look at where the trend is ending. The downtrend ends, the uptrend starts. That's kind of the first piece to determine, okay, do I want to get in a trade? So when it comes to drawing the fib retracements, it doesn't really matter what platform you're using. The charts that I have here are on Thinkorswim, which then went to acquired by TD Ameritrade and now acquired by Schwab. But I still prefer to use their platform and charts with day trading. I've used Infinity Futures for my trade ladder before, and then lately, last couple of years, I've switched to using TradeOutLoud. I think it's really clean and easy to use. So I kind of like having the two separate. If I'm swing trading or doing options or like my retirement accounts, all that stuff is with Thinkorswim. But I try to keep things as simple as possible. But from a trade ladder perspective, I do like TradeOutLoud. And so using the Fib tool, I say that just because doesn't really matter what platform you're using. Nothing is really that customary or whatnot. I just find that with drawing on charts, it does take a little bit for your eyes to get used to, where you're looking. And if you're setting up your charts in a certain way, sometimes they can become really cluttered and they become overwhelming. So it's really helpful to kind of find something that kind of looks good to you and that you're comfortable with, and then just stick with it for a while and try to really simplify and simplify and simplify. And anything that you're not using to enter, manage, or exit a trade, just get rid of it off your screen. And that will make like the decision process a lot easier because you're not stuck kind of being distracted by all this other stuff that you think might be helping, but really is just a distraction and slowing you down. So when you're drawing a retracement, you always want to be going from left to right. So it doesn't matter what chart you're on, what time frame, you want to go from left to right. And so I really only put on the 61.8 and then the you could call it a 123.6 or a minus 23.6. Same with a minus 61.8 or a 161.8. Those are really the only three fib numbers. The 50% that I use is just kind of a midpoint for reference. It's not a fib number. It just helps me see where that halfway point is. And that's kind of what I'm using to identify my entries. And so the 50% is kind of the entry point. The 61.8, this is looked at as like the failure point when the trend has gone so far beyond 50% that it's less likely to resume. And then the minus 236 and minus 61.8 are sort of used as targets projecting out, in this case, in the downtrend, where might we become a little bit extended to the point where we might get another pullback. And so that 50% isn't a fib number. It's just used as sort of an arbitrary entry point, if you will. The 61.8 is kind of the stop area or zone. And then the minus 23.6 is kind of the target. And so the nice thing about setting up your charts this way, you can draw on a daily chart. You could draw on a 5-minute chart. You could draw on an hourly chart when the range is 10 points wide or when it's 50 points wide. And the ratio of like stop size to target always stays the same. It might be smaller or bigger, but you're always kind of in that 4-to-1 reward to risk with a projected minus 23.6 target and a 50% entry. So when it comes to specifically trading the E-mini S&P, I use a 2-point stop and a 3-point target for half of the position. So again, trying to keep things as simple as possible. A 2-point stop, and when I put on the position, I just cut it in half. And the first half, so let's say 8 contracts, you cut that in half. 4 contracts get a 3-point target an arbitrary target that goes out every time. And in the second half, the other 4 contracts, I just trail that stop. And that is what really helps to reduce your risk early in the trade, but still allow you to catch those big winners. So we'll get into more of those specifics here in just a second. So negative 23.6 target, 61.8 stop roughly, and the 50% 8 is the kind of that entry point. So as you're drawing your retracements, starting from left to right, as we just mentioned, looking for that 50% as sort of the pullback. Okay, I start from left to right. In this chart example, I'm ending up with a downtrend. So that means my entry is going to be a short. And then when we move our way or make our way down towards that negative 23.6, then I can draw kind of the next retracement as the market bounces and use from whereabouts my entry was, that swing high, down to the next low. And you can see that pattern of swing high, swing low, swing high, swing low, swing high, swing low. That's very helpful for drawing up your retracements using that fib tool to grab, okay, the next swing high to the next swing low. And then we continue down, the next swing high to the next swing low. And so you kind of pair those things together, the swing highs, the swing lows, with just a basic Fibonacci retracement tool, and you can really help yourself stay in the trend, be trading in the direction of the trend, or thirdly, identify when that trend is changing. And so knowing those things can, even if you don't use the fib tool to place trades, maybe you just buy above the high, the low bar, or you're using some sort of whatever entry it is, MACD, stochastic, doesn't really matter. You can use just these basic swing highs and swing lows and the fib retracements to help you identify what the trend is or lack thereof. I like to talk about extensions here briefly. It's a little bit more advanced, but it can be a helpful way to protect yourself if the market really starts selling off or breaking out. So the traditional retracement, if I pull up this last chart again, swing high to swing low. So I'm grabbing from a high and pulling to a low. If this chart was flipped upside down and I was drawing a long, it'd be a low to a high. So I'm kind of always grabbing from the opposite swing, a high to a low or a low to a high. Well, with an extension, you're still drawing from left to right, but you end up with, like this would be the traditional swing high to swing low. An extension would then be a high to a high, or like in this chart, a swing low to a swing low. So when the market gets selling off, in this case, moving down, sometimes we don't make a full retracement to that 50%. We don't pull back to kind of the traditional fib retracement. And that's when you can draw an extension from low to low for a short, or high to high for a long. And the way to think about it is like, okay, if we're in a very strong market or a big sell-off, that's when the market isn't going to retrace all the way. And you can think like a bull or bear flag. The market moves almost straight down in a way, or very strongly down, and then moves sideways, and then moves down again, and then moves sideways. And a lot of times that flag is only like a third of the pole of the initial move. So if the market moves down 12 points pretty abruptly, straight down, then the bear flag portion should only be like 4 points, like a third of the move. If you start getting, a move back up all 12 points, now you end up with kind of like a V, like a reversal. So bull or bear flags are good ways to identify those bull and bear flags with the extension. So, and sometimes it's just too late to get in. Like if sometimes the market just gaps down or gaps up like especially Monday morning, and then it just doesn't do anything. It just goes sideways. And so Dow might be down 500 points, and then it closes it, down 505. And there wasn't really much to do during the day because that move occurred on the gap or after hours, if you want to look at it that way. And that's okay. Sometimes it's better to just not do anything than get chopped up, take a whole bunch of stop outs, and then you're sitting there saying, "Oh, I wish I was just flat in the day instead of taking a bunch of losses." And then with those gaps, I forgot what I was going to say. But yeah, sometimes it's just a little bit too late. And so by understanding what the trend is by looking at those swing highs and swing lows, sometimes we might be in an uptrend for like the first half hour of the day, and then let's say we fill the gap from yesterday. Like we gap down at the open, but then we rally and trade where we were trading at the close from yesterday. And that uptrend starts to break a swing low. You're making higher high, higher low, higher high, higher low. And then you fill the gap, you're met with some resistance, and then you sell off and you start moving down. Okay, now it's a good time where you can jump into that new downtrend, wait for that little bounce, and then short it, and then you're early on and you can ride it down, and next thing you know, boom, you got 3 points locked in, and then you're just trailing your stop and you are kind of off and running. So the one thing that you don't want to end up doing is chasing. So if you drop 3, 4, 5, 6 retracements in a row and you for whatever reason didn't get in any of those, you don't want to wait till you're on retracement 7, 8, 9 to try and jump in. Obviously, the bigger the time frame, the slower it's going to take for a retracement to happen. If you're looking at an hourly chart, you might have 2 or 3 retracements for the entire trading day because it takes so long for the market to go up and then pull back. But if you're looking at like a 1 minute or a 5 minute chart, okay, there's going to be a lot more little retracements that you can draw. So you don't want to get stuck chasing. I often find that the picture perfect setups don't always work out like you plan, but the setups that you're looking at, you're like, yeah, it looks pretty good. I mean, it meets my criteria, broke the swing high and pulled back to the 50 and, looks okay. Those are the ones where you're getting in early before everyone else is in. And then, when you can call it the smart money or veterans or whatnot, you're getting in early. And by the time the trend really does take off, you're getting out of the trade, taking your profit, and somebody else might be jumping in, and then shortly after they get stopped out because the market rolls over. So when it comes to kind of the trade execution, I talked a little bit about it, but kind of walk through the steps that I use. First, looking at the chart, kind of need to wait for a break of a swing high or low to establish, okay, if we break a swing high, market was in the downtrend and we break a swing high, we could be starting an uptrend and vice versa for a downtrend. So I like to wait the first 15 minutes. If I start the trading day 9:30 Eastern, I wait those first 15 minutes before taking a trade so that I can get a little bit of intel, let the market kind of settle down from those first few minutes of opening. You get a swing high and a swing low established. If you look at any kind of like market internals or any other data, you can just kind of, it gives you a few minutes to process what's going on. Sometimes you find things like, oh, today looks a lot like yesterday morning at the opened, and we know what happened yesterday. So some of these days, a lot of days actually, kind of end up mirroring each other in a very early on in the day. Like if you printed out a whole bunch of charts of just trend days and you just put them out on your office floor and looked at them, or your desk or whatever, looked at those trend days, you'd start to see similarities between the trend days. And then do the same thing, print out a whole bunch of, 15-minute charts of a bunch of range bound days. And you put those side by side and you're like, oh yeah, all these charts kind of look similar. And if you look at those first, 15 to 30 minutes, you start to see very similar characteristics. And so that's why I find that, if I wait 15 minutes, it prevents me from just jumping into a trade right off the bat and getting a stop out in 2 minutes after the bell. And then you're kind of like, oh shoot, I'm off on the wrong foot. Versus, yeah, occasionally there might be a nice little setup in the first 15 minutes, but more cases I'm going to end up with a stop out or two and wish I didn't take it than the occasional winner that I miss. So that's how I kind of set myself up for the open. I like to look at the prior day's high, low, and close. And I don't do a whole lot of, looking at the overnight trading hours. You could look at the overnight high and low and kind of see what was going on in the overnight. Like, were we trading above the prior day's close all Globex session, or were we trading below the prior day's close? But for the most part, I just kind of, check on the markets when I wake up, go through morning routine, have coffee, walk, whatever, and then sit down. And that's another reason that first 15 minutes kind of gives me some time to digest what's going on as well. So once I've identified, okay, we have, let's say the first 15 minutes we were trading down and we broke a swing high, then I can draw that first 50% retracement and look at that as kind of the first opportunity for an entry. I prefer to use what's called a tick chart for my intraday trading. So without getting too deep into the weeds, 512 tick chart is what I like to use for trading the ES. If you use a 5-minute or a 1-minute chart, that's totally fine. But for those that are wondering, I like to use a 512 tick chart with a Fibonacci candlestick study on top of it. And so that's what this chart is kind of depicting here. 512 tick chart with a Fibonacci candlestick, and then I'll put like a 5-minute chart next to that just to give me some bigger time frame picture. And that's really all that I have in my charts. I keep it pretty simple. I only look at one market at a time. I'm mostly trading the ES, but if I was trading the NASDAQ, I would just toggle back and forth versus having 10 monitors and all these different charts. I just find that the more I have to look at, and like the more decision tree I have to go through to make a trade decision, then it causes hesitancy. And you're on a time crunch when placing a trade and making the decision to place the trade, that anything I can do to speed that up is going to be beneficial. So I like to place limit orders. And that way, once I draw the retracement, I know where the 50% is even before it gets there. So I can drop my order at the 50%. I usually take whatever the 50 is. And if I want to go long, I'll just round up, because it doesn't always land at quarter, 50, 3/4, or evens. At least with the ES, Dow and NASDAQ trade in $5 increments. ES, it's 1250. So each market is slightly different, but I'll just move it, put my order, round up, add a tick, and that's where I place my limit order. So my order is ahead of price getting there. And for some of you, some of this stuff might be a little bit more advanced than others. It's sounds like common language, but at least you can go through and rewatch the presentation for some of the little more nuanced things. But I like to put it all out there because it is there are some important pieces that you can only really master by doing. And so sometimes this is kind of like reading a book or listening to an audiobook. You you read the book and you take some stuff away from it, and then 6 months later you read the book again and you pick out a whole bunch of stuff that you didn't really pick up on the first time. So at least it'll all be in there and you can review it later on. But just using a limit order at the 50%, and like I said with the ES, then I just have a stop go out at 2 points if I get filled, and a first target go out at a 3-point target. You can also use that 61.8. I put this in here because the 61.8, if you're on a different time frame than the 512, and you just want to kind of put your order at the 50, put your stop outside the 61.8, and put your target at the -23, then you can go about trading different time frames and use the exact same parameters. Whereas if I use a 2-point stop on the ES, which is $100 per contract, on the NASDAQ, that's going to be 20 points to get that same $100. So there's, a couple of slight tweaks if you wanted to keep the same, ratios or dollars at risk. But if you want to just look at it as, okay, I'm going to place my order at the 50, I'm going to place my stop outside the 61.8, and then I'm going to target the -23. Then that gives you the freedom to go to a daily chart, to go to a stock, to go to the futures on an intraday chart, and you're not making any changes. And that's really beneficial because if you've ever looked at complicated systems, they have all these moving parts that are based off of, a certain average true range or very specific market conditions. Well, then as soon as the market changes, then the things start to break down. So one of the big things that I learned from, some trading mentors who'd been down on the board of trade, and then in the 80s, they kind of moved to early days of computerized trading, and they would just step into the pits to place their orders. And then shortly after that, in the 90s, then it was just all computerized trading and placing the orders and doing everything from the computer, not even going into the pits again. You got to have something simple because, unless you make 2 or 3 trades and knock it out of the park and make your 5 million bucks and then stop, you kind of want to make this be a long-term endeavor that you can do for 10 or 20 years if that's your goal. If your goal is to just quit your job and start trading and then retire in a year, there's definitely a lot more luck that would be needed to hit things just right and have a big enough position size that your winners can allow you to do that. So that's not super realistic. I've found that the slow and steady approach kind of gives a lot more, alleviates a lot more stress, a lot less stress, and allows you to kind of do it in a way that's integrated with your life. And so I only, day trading perspective, am using the first hour and a half or so, 2 hours of the day to day trade the ES, and then I have the whole rest of the day to do other things. And so if you're kind of integrating trading with your current day job, or maybe you're retired and you would rather be playing golf, but you want to have a way to bring in some extra income, then sitting in front of the screen for 12 hours trading, it can get a little bit old and isn't necessarily aligned with perhaps your goals of freedom, flexibility, time. So just a couple side notes to think about, but keeping things simple is a really big part of my trading and pretty much everything I do. So once it comes time to, once you get to the -23% retracement, trailing your stop becomes really, really beneficial. So if you were targeting the -23.6, let's say you had 100 shares and you took 50 shares off at the -23.6, from there, you could trail either the next retracement by taking the next swing low to swing high and put your stop under that 61.8. You could also trail the swing lows or swing highs if it was a short. And that way, you're letting the market pull back. And then once it makes a new high and makes a higher low, you have an opportunity to tighten your stop. You can also trail each candle. And I do this a lot on daily bars But sometimes intraday, the market, like in this case, pulls back to your 50%, and then it just rips. And all of a sudden you're up 8 points, 9 points, 10 points. And it's like, well, I don't really want my stop to, even if I do take a 3-point first target, I don't want my stop to be 7, 8 points away, because I could just as easily get out and get back in with a tighter stop if I wanted to. And so while in most cases, staying in, like taking fewer trades and staying in them longer is much my preference. If we get a really quick rip, and this often happens in shorts, where like you happen to get in early and or just before a big drop, and if you catch it just right and the market does start to roll over and sell off, yeah, all of a sudden you could be down 10, 15, 20 points, and or you're up, but the market's down. And just by trailing your stop as best you can, each candle, even if it's just a point or a couple ticks below each candle's low, I'm basically just dragging my price down on the trade ladder. Or if you're trading on the same platform that you're doing your order execution, sometimes you can have your price show up on the chart, like a line of where your stop is on the actual chart. Then you can just drag it up or drag it down, which is actually quite handy. And so sometimes I'll trade on Thinkorswim for that reason, but some of the other platforms, as far as futures trading goes, have really small intraday margins of like $500, whereas like with my Thinkorswim account, I think it's like 13,000 per contract. So I mean, you kind of have to have a bigger account to be able to do that. And so being able to lock in a profit, whether the market is ripping or just kind of steadily making higher highs and higher lows, or whether you're just going to trail the next retracement, it gives you some flexibility to be able to mimic what the market's doing, maybe what you saw happen 20 minutes before and how the market's trading. But it's also going to get you out of a trade if the trend starts to change. Going back to how you got in the trade, if the market was moving down and then it broke a swing high and you got in the long at 50%, if all of a sudden the market comes up and it starts to break a swing low and then rolls over, that's a good place to get out. And so whether you're just trading, the one market, trading the ES for hour and a half, 2 hours in the morning, or if you're swing trading, whole bunch of different stocks, you kind of take this framework, if you will, and apply it to different markets, different time frames, and it becomes really useful. So some tips that I like to make sure people know that I do. I always start my drawings at the market open versus like using 24 hours worth of data. I definitely get lots of questions about that. On Tuesdays, I do a live trading session, if you will, where I pull out my charts and then I go through just as a normal day, but then have chat capabilities so people can chime in with questions, and I do my best to narrate as I go. Hey, I'm looking at this trade, and or I put the drawings in the charts and then kind of narrate what I'm thinking as best I can. And I always like to start at the open because that's where the volume comes in. And sometimes, well, pretty much all the time, the overnight trading session is just the volume is so low that it doesn't mean a whole lot. Even if you have a big gap, the close at market hours, the market close is much more valuable to me than anything that happened in the overnight. 5-minute chart is really helpful for intraday trading. On a daily chart, I'm just using a daily bar. Like for a swing trading trade, I don't do anything but look at the daily chart. I don't drill down on the stock and go to a 5-minute and a 1-minute and try to pinpoint to the second the entry. It's just daily chart. But intraday, I find the 5-minute chart and that 512 tick chart is really helpful. So 512 tick is good for S&P, NASDAQ, Dow, Euro futures, lots of different markets. I use that 512 tick chart for. You always want to draw left to right. Sometimes for the folks that are super green to drawing retracements, that can get a little confusing. Oh, do I draw, is this a long or a short? Well, you always start from the left side of your chart and go to the right. And then looking for those significant swing highs or swing lows as a starting point is also really helpful. That way, if you come in to the day and it's lunchtime, just, okay, where's the high or the low for the day, and start there, and then start your drawings. Or if you want to go back and practice, that's another good reference point to find a starting point. And then once the 61.8 fails, or you break the 61.8, then you kind of start looking for trades in the other direction. And so if you start to see, we broke a 61.8 long, then we broke a 61.8 short. Okay, there's a good chance that we're going into a range-bound, non-trend environment. And that's a really, really helpful tool or practice, if you will, to identify, okay, things could be getting really choppy here. And at that point, if you break a long and you break a short back to back, I just kind of put a rectangle around from the high to the low of that area, and just stay out of everything in the middle. Just wait till we make a new high or a new low. And sometimes the whole morning just ends up in that range and there's no opportunities, but it protects me from just having a whole bunch of stop outs and being frustrated and getting into a downward spiral. And then you come the next day and you feel like you're just digging yourself out of a hole, and it can compound into a whole big mess. So if you have back-to-back failures of retracements, then I find it's better to just sit tight, sit on your hands, or sit out, whatever term you want to use. And then the final note I always like to leave with is there's really no shortcuts or substitutes for the actual time in front of the screen. So you could, look on paper, hey, here's ABC, this is what you have to do to trade. Look for the setup, place your order, bing, bing, bing. But in order to have like the confidence, I'm kind of a numbers person. So for me, having 50, 100 trades, under my belt when I was first starting was really helpful to see, okay, how am I progressing? And how does this 100 trades compare to my last 100 trades? And so now when I've got, 12 years, 15 years, 12 years or so of day trades, 15, 16 years of, going back with swing trades. If I start to see, hey, my R multiple or my expectancy is starting to shift, it can help me with my decision making. But if I have a couple of stop outs over 200 trades, it's like it barely moves the needle. It's not a big deal. But if I notice that I usually don't have, very big drawdowns, and all of a sudden it's like, oh gosh, my last 4 trades have been losers. It can kind of be a red flag, and I say, oh, am I not seeing something correctly, or is the market just, acting weird or something like that? And so that time in front of the screen is what helps build that confidence and helps shorten your decision making time and kind of your quickness of just jumping on the order, getting in the trade, managing the trade. And then when okay, I got my stop set, and if it goes in my favor, this is where I'm going to get out. This is how I'm going to manage the trade. Then you don't just panic and end up hitting the flatten button for, hey, I got a point out of the trade. And then it goes 10 points and you're like kicking yourself. So time in front of the screen is super important, just as, time as a resident, if you want to become a doctor, or time on the bench as a lawyer or whatnot. There's not really a good substitute for that screen time. You can speed up some of the learning curve by, attending these kind of presentations, and really after the market's closed, paring down and simplifying your personal trading approach. You have a whole bunch of notes, so you just go through and, clean them up, shrink them down. What do I actually need to trade? Get it down to a 3x5 note card, and then just focus on that and quit jumping around from strategy to strategy to strategy. Just kind of hone in on something and then really focus in. And that can help speed up the learning curve, but then get the time in front of the screen, even if it's only that hour and a half every morning, just that repetition over and over and over again. you start to go through a bull market, a bear market, a sideways market. Next thing you know, 6 months goes by, you're starting to have a little more confidence. A year, 2 years goes by, now you've got hundreds of trades under your belt, and it really does, I found, make things easier over time. And then it's important to work smart, but also be patient and stay disciplined. And so for me, shrinking that time window that I need to stay focused helps me stay disciplined. If I just sit here all day long, your mind starts to wander, you start just Googling stuff or getting bored, and then you make mistakes, and then you're just kind of derailed. So the smarter and more focused and intentional you can be with your time, the better. Keeping things simple is super important. I've got a whole bunch of different articles and videos and stuff that I put out over the years at emoneymind.com. You can check out, and you can also shoot me an email if you have specific questions, whether it's trading related or mountain biking or anything. Happy to chat. Tim at emoneymind is my email. And thanks everyone for tuning in. The presentation is recorded, so you'll be able to review that afterwards. And I always like to thank David for putting these on, and appreciate everyone for tuning in.